Good morning and welcome to Chapter 4. This particular chapter we're going to talk about completing the accounting cycle. Now, as you recall from Chapters 1, 2, and 3, we've kind of looked at the financial statements overall in Chapter 1. Chapter 2, we looked at journal entries, just regular journal entries and just debits and credits. Chapter 3, we looked at adjusting entries and how we adjust the financial statements based off of transactions that are happening. For example, we looked at depreciation and prepaid insurance and prepaid rent, unearned revenue, etc. Well, in this particular chapter, we're going to just look a little bit more detail of looking at the financial statements. And this will look very similar to what you saw in Chapter 1. But what we want to focus in on here is just looking at how the accounting cycle and how the financial statements articulate one to the next. And we're not going to spend any time on the statement of cash flows. We're going to look specifically at the income statement, the statement of retained earnings, and the balance sheet, and that's the order that you prepare these financial statements in. And so let's take a look at Chapter 4. So we're going to look at how to prepare the financial statements. And this is going to look very similar to what we saw in Chapter 1. There's not going to be much difference in what we've seen, but we're going to talk specifically about information on the balance sheet, classified balance sheet. And what it has to do with a classified balance sheet is going to be a function of when things are due and when they're and how they're due. And so that's what we're going to work on here in Chapter 4. The financial statements. We have three main financial statements, and we touched on this in Chapter 1, but we're going to go review it again. You have the income statement, which reviews revenues and expenses and calculates a net income or a net loss. Recall that on an income statement, if the revenues are greater than expenses, you have a net income, and if the revenues are less than expenses, you have a net loss. We're going to take a look at retained earnings, and a function of retained earnings is really the profits that the business has retained within the business to continue to grow the business. And we're going to look at how those are changed. And one of the key components, there's three key components to the statement of retained earnings. There is the beginning retained earnings, your net income or net loss, where you add a net income or you subtract a net loss. And then there is dividends, which are a distribution of profits of the business. So we're going to look at that. And then the last thing we're going to do is we're going to look at the balance sheet, and we're going to look at assets, liabilities, and stockholders' equity. And we're going to take a look at them and determine what the balance sheet is for the business. And really, it's a listing of what the business owes or owns and then a difference. So here's an adjusted trial balance. If you remember going back to Chapter 3, we did adjusting entries, and you look at a couple of different accounts here. You have prepaid, we adjusted accounts receivable, office supplies, prepaid, accumulated depreciation, this unearned revenue, salaries payable, and interest payable. And we've adjusted all of these particular entries when we did our adjusting entries. And you notice how this is broken down on this adjusted trial balance. It has assets first, then it has liabilities, then it has stockholders' equity, and then the revenue and expense accounts. And you notice that it's in the order of liquidity for the assets, and it's also in the order of liquidity in the liabilities. Liquidity in the assets, what converts to cash fastest. Liquidity in the liabilities, not really liquidity, but what liabilities are due when. And then it has the income statement accounts on the bottom. And what we're going to do is we're going to go through using this particular trial balance. So if you have your book, you might open your book to this particular trial balance when we go through the financial statements for Chapter 4. Okay? So each one of the financial statements relates to the next. The net income or net loss flows from the income statement and goes to the retained earnings. And then the information from the retained earnings goes to the balance sheet. And so we start here with the income, which we look at the bottom part of the financial statements. Of the trial balance, the adjusted trial balance. And we have service revenue was $17,500. And you notice that the expenses were presented in the highest to lowest, and those are basically, if you were to kind of look at this, revenues are cash in, expenses are cash out. And you have salaries expense. So you take the largest to the smallest in the expenses, not in alphabetical order. But if you were doing this on a test, I would just say just pick up the expenses as you find them. Don't worry about alphabetical order. On this particular set of financial statements, it says that the business made $8,550. A couple little format things I want to point out to you. In the income statement, it's always going to be for the months ended. The months ended. And you notice that there's a dollar sign on the top of the column, but there's not a dollar sign on all the rest of these. And when they make a total, there's an underline, and then that tells you that you're going to make a total, or there's some kind of math operand, if you will. And then if you take the revenues minus the expenses, even though there's not signs in here, this line tells you there's math, and then that tells you that's your final number. So you know this obviously has to be plus this, minus this gives you this, and then a double underline tells you that you're a total. Notice net income because revenues are greater than expenses. We're going to take that net income, and it looks like this must have been a business that just started. Let's start at the top of this again. Smart Touch Learning, statement of retained earnings for the 2 months ended December 31st, 2016. And we have net income for the 2 months, $8,550. That comes from the income statement. And then we have dividends for the 2 months. It said that they paid out $5,000 in dividends. And what ends up happening is you have retained earnings of $3,550, and that becomes the ending retained earnings from the balance sheet. So those are the steps that you have so far. And if it helps you, the statement of retained earnings bridges the income statement to the balance sheet. If that helps you understand this concept a little bit better. We go to the next one. We have a simple statement of cash flow, a balance sheet. And we took the information from the statement of retained earnings, and we put that here in the bottom. That's $3,550. Now let's go back to the top because there's a couple other things I want to point out to you. First, the same thing, the header. It's a balance sheet. And now you notice it doesn't say for the month ended or the 2 months ended December 31st, 2016. It just says December 31st, 2016. Because the income statement is the balance sheet, is at a point in time, not over a period of time. These are the balances that we have, and you notice we have assets or what we own, 12,200, etc. All these numbers, but you notice that you have these accumulated depreciation numbers that are subtracted from the long-term assets, and then you have land, and this gives you your total assets. And on the liability side, they're not presented in the largest to smallest. They're presented in the order of when they're going to come due. So you have $62,000 in liabilities and $51,000 in stockholders' equity. So you take the sum of these two, and it gives you total liabilities and stockholders' equity, and these two have to balance. That's the definition of the balance sheet. What we're going to do now is we're going to extend our discussion a little bit more with the financial statements. And what we're going to do is we're going to look at the financial statements, particularly we're going to focus in on the balance sheet, and we're going to look at a classified balance sheet. And we're going to take these assets and liabilities and classify them into long-term and short-term when they're due, long-term and short-term, because it makes a difference. In long-term, short-term is really current, and long-term is going to be long-term or long-lived. And we'll touch on that here in a minute. And that's what we're going to talk about now. The classified balance sheet puts each one of the assets and liabilities into a category, and liquidity is how they're going to convert to cash or how much they're going to have to be paid in cash. So we're doing that for both assets and liabilities. And you say, why is that important? Because it allows you to understand where the business is going to go and what they can do as far as are they going to be able to meet their current obligations. In other words, what they owe with what they own. And if they're not going to meet those current obligations, then a bank may have an issue with them. So let's talk about the classified balance sheet. So classified assets first. Current assets are converted to cash or used within 12 months or within the operating cycle. I'm not going to get into the operating cycle because most businesses don't have a super long operating cycle. You might think of a company that has a really long operating cycle, like maybe a business that makes wine, because they ferment the wine and it stays in wine barrels for a period of time. So their operating cycle is going to be much longer. Most businesses are going to have a 12-month operating cycle, or most entities. And I just don't want to say businesses because you could also say entities. Like the school here, the university, has a 12-month operating cycle. It starts September the 1st and ends August the 31st of the next year. That's current assets. Long-term assets are going to be assets that are going to not be used up within a year, but are going to have a longer life. So a truck, a building, a piece of equipment, they're not going to be used up typically within a year. There's always some debate about computers. Are they used up within a year? No, but a lot of businesses will not classify them as long-term assets because they're really kind of disposable after a period of time. And so this just kind of gives you an idea of the difference between the two. Current liabilities, same kind of concept. They're going to be paid within a year, or the entity's operating cycle, which we talked about already. So you have accounts payable, salaries payable, or unearned revenue. Those are all examples of current liabilities. And long-term liabilities, generally speaking, long-term liabilities are going to have interest associated with them, like notes payable. Notes payable is going to be a long-term liability, or mortgage payable, interest that you're going to have to pay. So let's go back and talk just a little bit about current assets for us and current liabilities. Current liabilities and long-term liabilities are probably a good example that I can relate to this to you in your real life. Current liabilities are going to be bills that you pay every month. Those are going to be current liabilities for you. Long-term liabilities might be your student loan or might be your car loan. Even though student loans, the interest in most cases does not accrue or does not add while you're in school, those are definitely long-term liabilities that you're going to have to pay out over a period of time. And they have interest associated with them. So that's the difference between the two. And stockholders' equity, which we touched on in Chapter 1, is the claim against the assets of the business. And it's the difference between the assets and the liabilities. Where it says here it's the claim. It's the claim after the assets, after the corporation has paid all of its liabilities. Let's go back and take a look now and recast our balance sheet. You notice we didn't look at the income statement or the statement of retained earnings. We're just looking at the balance sheet, and we start with the assets. You notice now what we've done is we've classified the assets between current and plant assets, which I think the better term here would be long-term assets. And what you have now is you have 16,100 in current assets and 97,450 in long-term assets, or sometimes they might be called fixed assets. Still the same number we saw earlier, 113,550. And in current liabilities, you have $2,000. And if you kind of go down the list, accounts payable, utilities payable, salaries payable, interest payable, unearned revenue are all current liabilities. And if you look at long-term liabilities, you have only notes payable. You sum those two up, and it says that you have $62,000 worth of liabilities and $113,000 worth of assets. So that's actually pretty good, because basically that's saying that they have not quite a 2-to-1 ratio, or right there about a little bit, not quite a 2-to-1 ratio. Because if I took $113,000 divided by $62,000, it says you have $113,000 worth of assets and you only owe $62,000. So that seems like it's a pretty good deal for the business. The stockholders' equity section, however, does not change. Does not change. It stays the same. Remember, this number came from the statement of retained earnings. This is common stock, and there's your total, and still our balance sheet balances. That's important. So why do we want to, what we're going to do now is we're going to talk about journalizing and posting closing entries. And what we're going to do when we journalize and post closing entries is we're going to close accounts, we're going to close temporary accounts to permanent accounts. And if you look at the trial balance that we talked about, that it had you look at from the start, anything from dividends down in that trial balance for the Smart Touch trial balance is what we're going to close. And those are going to be all temporary accounts. We're going to close temporary accounts to permanent accounts. And if you want to think of it this way, anything that showed up on the balance sheet is going to be a permanent account. And in fact, everything that you close ultimately will land in that retained earnings account when you do your closing entries. So let's take a look at the journalizing and posting entries. Here we go. Temporary and permanent accounts. This is what we just talked about. Go back and look at your trial balance, and you look at the permanent accounts are what you own and what you owe and the difference. So assets, liabilities, and equity are going to be your permanent accounts. Temporary accounts are revenues, expenses, and dividends. So we're going to close revenues, dividends, and expenses. And just so you remember, the balance for revenues are credits, then the normal balance. The normal balance for expenses are debits, and the normal balance for dividends are debits. So when we want to close these accounts, if I want to get rid of the balance that I have in revenues, which is a credit, I'm going to have to debit it to close it. And if I want to get rid of the balances that are in expenses, I'm going to have to credit that account to close it. And when I want to close out the balance in the dividends accounts, I'm going to have to credit it to close it. These accounts on this side on the right, the permanent accounts, never get closed. They always stay the same. And that's what we're going to try and do with these closing entries. All right. So, closing entries. Closing entries transfer revenues, expenses, and dividends to retained earnings to the retained earnings account. Revenues and expenses may be transferred to an account titled income summary. So the income summary is a new account you haven't seen, and don't let somebody trick you. There's not a normal balance for income summary, if you will. There's probably a normal balance which is not a debit or a credit, but is zero, and we're going to close it into this account. We're going to close the revenues and expenses are going to be closed into the income summary, and the dividends are going to go straight to retained earnings. So let's take a look at this little diagram. Expenses. So if we're doing a journal entry for expenses, we're going to do a debit to income summary and a credit to retained earnings, and we'll look at some numbers here in just a little bit. And then for the revenue, we're going to do a debit to revenue and a credit to income summary. So all we've really done is move the amounts from the revenue account into income summary, and we've moved the debits from the expense accounts into the income summary, and then ultimately we're closing those to retained earnings. Now remember, when we had our statement of retained earnings, we put that amount on there in our statement of retained earnings. Now we're just moving the accounts on the outside in there as well. And then the last thing we do is we're going to close the dividends. This is step 4 in the bottom left. We're going to credit dividends and we're going to debit retained earnings, because a dividend is really a distribution of profits, and profits are sitting in this retained earnings account. And here comes our ending balance. Okay, so here's one. Here's the first one that we're closing. This is just closing the service revenue account into income summary. So what we've done, here's our closing entry number 1. We're going to debit service revenue for $17,500, and we're going to credit income summary for $17,500. And now we're using this new account, and so far the income summary account has a net credit balance of $17,500. The service revenue account has a 0 balance. We go to the next one, and I don't know why the expenses ones didn't show, but there's an expense one as well. And oh yeah, here it is. And here's the expense closing. So what we've done is we've credited all of these expenses, and we've debited income summary for that amount. Debited $89,000 or $8,950, and all these expenses were credited to close those accounts. And we should have some T accounts. We don't, but if we had the T accounts, you would see. So here's our debit for expenses to the income summary for the expenses, and the 17 was the revenue, and this $85,000 or $8,550 represents the amount of net income that we have. That's sitting in the income summary account right now. And then we're going to do our last closing entry. What we're going to do is we're going to debit income summary, and we're going to credit retained earnings. And this is in T account format on the top, and this is in a journal entry format on the bottom. And the T account is just a picture of the general ledger, but if you're doing journal entries, this is the way you want to do your journal entries, just part on the bottom. And now the last thing we want to do, so we want to now close the dividends, which were a distribution of profits. And remember, when we paid out dividends, we debited dividends, and we credit. And now what we're going to do is we're going to close out retained earnings, or dividends, excuse me. So what we're going to do is we're going to credit dividends, and we're going to debit retained earnings, and this closes out the dividends account. Our ending balance in retained earnings, $3,550. And if you take a look, what you might find interesting is that $3,550 is going to be the same balance that you have and retained earnings on your statement of retained earnings. If you do that, then you know you did it right. And here's a summary of the post-closing, the journalizing and posting closing entries. This is Exhibit 4.6. This is just the journal part. The posting would be like what you looked at on the T accounts. And you can see what has happened here. We've debited revenue, we've credited income summary, service revenue, that closed out the revenue account. We've debited income summary for the expenses and credited all the expense accounts. And then we finally we debited income summary for $8,550 and we credited retained earnings. Now, be careful. If service revenue is less than the expenses, let's say this was $4,000 and this was $89,500, you would have a reversal entry here, because you got to remember, if you drew this in a T account, if you said, okay, I'm gonna credit income summary only for say $4,000. Well, what happens in that case is, because your revenues your expenses exceeded revenues, that means that you had a loss. So if you had a loss, this particular entry would be backwards from what it is presented here. So don't memorize the fact that you have to debit retained earnings, or debit income summary and credit retained earnings no matter what the balance is. You have to really look at it and do an analysis of a T account to figure that out. So don't just try and memorize. Actually understand the principles and the concepts of what you're doing. And here's what they're talking about if you have a loss. This is exactly what they're just talking about. So remember, this number would represent the revenues, okay? $3,000, just like we had in our last example, which was like $17,000. This number represents expense. So we have a $2,000 debit balance in the income summary in this particular example, because revenues were exceeded by expenses. So we're going to credit income summary and we're going to debit retained earnings. So we actually have a debit balance in the retained earnings account because the business lost money in this particular accounting cycle. So let's look at the post-closing trial balance. And what we're going to do is we're just going to do a listing of the accounts just like a trial balance, but the only difference is it's only going to have permanent accounts, and here's what it looks like. And what's interesting about these permanent accounts, they're all just balance sheet accounts. And remember here, when we did our adjusting entries, or our closing entries, we had a balance of $3,550 in the statement of retained earnings account, and this is also the same balance that you had in your statement of retained earnings. And what this tells you, the reason we do this trial balance, remember, is to make certain that we did our debits and credits correctly. Okay? And let's talk just a moment about the accounting cycle for those of you that follow the accounting cycle. Let's start with, let's go step one. You start with the account balances. So this is basically starting off with a trial balance. Maybe you had a business that's been in existence for three or 4 months or 3 or 4 years, and you have beginning balances. Then you analyze transactions as they come in, and you determine what happens with those transactions. This particular one, this number 2, looks to me like it says that they sold something on account. And then you post them, and remember so this is journalizing. Then you post them to the general ledger, and a T account is a picture of a general ledger. So we've taken 400 and we're just doing accounts receivable here. You'd also have a credit to service revenue, but we don't see that here. And then we balance them, and we create an unadjusted trial balance, and we're only using accounts receivable as the example. And we have $2,600, and they have the worksheet in here, but pretty much you're not going to do the worksheet, but you are going to look at adjusting entries. So you're going to look at adjusting entries, and you're going to journalize and post those adjusting entries. And the adjusting entries that we covered in Chapter 3 are going to be prepaid rent, office supplies, unearned revenue, interest payable, accounts receivable, accruing what you owe, and also accruing accounts payable. And you have they're called accruals and deferrals, and you can go back and take a look at those from Chapter 3. You create an adjusted trial balance, and with the adjusted trial balance, you create your financial statements, and you create them in the order that they're presented here. Income statement first, statement of retained earnings second, and adjusted trial and a balance sheet third. And those are the steps that you do in that particular order. Then you do your closing entries and once you do your closing entries, you create a post-closing trial balance, and you start over again. So here's the accounting cycle. And remember, here you're closing temporary to permanent accounts. This is what we just went through. All this other stuff we saw from chapters 2, 3, and 4. So this is really kind of a quick summary of 2, 3, and 4. And that's the accounting cycle. And he said, does that really happen in the real world? It happens every single month in the real world. So the answer to that is yes. All these things happen in the real world. Last thing, we're going to look at something called the current ratio. The current ratio is looking at current liabilities divided by current assets divided by current liabilities. Why is it important? It's important because they want to know if you're going to have enough assets that are going to convert to cash within the year to pay your current obligations of what you have for the year. And you know, if I were to draw a parallel to this to what you would look at in your real life, your thing might look a little bit different because you may not have assets that are going to convert to cash. You just have cash that's coming in the form of income, and you have liabilities that are coming in the form of bills. And so what they're going to do, what a lender is going to do, is they're going to look at what's your current income after taxes, and what are your current obligations? What are you paying for your bills every month? And they're going to do this when you're trying to buy a house. So if you're making, say, $1,000 a month, and you're paying out $600 based off of the bills, the firm bills that you have that you know you're going to have, then you're going to have a ratio of, you're going to take 1,000 divided by 600, and that's going to tell you about a 1.7 ratio, current ratio. So that's kind of what they're talking about here, because they want to know if you can meet your obligations with what you have coming in, and that's the most important thing for business. That's it for chapter 4. Look forward to talking to you again in chapter 5. I hope you're having a great day. Thank you.